question when we basically deduct all of this is that is inflation going to wane if issuance remains high, and if the Houthis will continue to wreak havoc with supply chains in the Red Sea? And once again, last week, we were at least partially right that European inflation would surprise markedly on the soft side of expectations. Expectations slowly but surely converge towards our view, but inflation is waning pretty fast in Europe, live at least. The question is whether we will see lagged spillovers of the supply chain disruptions in the Red Sea. I wouldn't rule that out, but in case we do not see large disruptions and large price increases to transportation, I'm of the view that the European Central Bank is off by maybe 1.5 percentage points in their inflation forecast for just the first quarter of 24. You're listening to Macro Sunday, hosted one, and welcome to the Macro Sunday podcast. I'm Andreas, Steno, founder and CEO of Steno Research. And today I'm showcasing the Once de Gala, I think that's the Spanish word for it, a whole pamphlet of analysts from Steno Research. First of all, my partner in the company, Mikkel Rosenvold, our geopolitical strategist. Welcome to you.
Thanks a lot.
And also a warm welcome to you, Mads Eberhardt, our head of cryptocurrency analysis. Good to see you.
Thank you.
And finally, we have my usual lieutenant with us remote, Emil Møller. Great to see you as well.
Cheers, live from the hideout here.
Yeah, and a big congrats on your third child, as far as I remember. Stop the count. I think we typically say that, right? But the reason why we've brought all of you in the studio today is that we have an action-packed program ahead of us. We've had a shaky start to the year, to say the least, in financial markets, driven, among other things, by developments in the Red Sea. And the overwhelming title of today's show is Spiking Freight Rates Bringing Back Inflation, ? Because this is basically the biggest question mark for investors and economists right now, judging from current price action. The situation in the Red Sea is quite worrying. So I guess we should start with that theme. And to get things going, I've found an old clip from the Pirates of the Caribbean, and I think it's quite telling for what's ongoing in the Red Sea right now. So here's a soundbite from Pirates of the Caribbean.
On deck, you scabrous dogs! Hands to braces! Let go and hold to run free! Now, bring me that horizon. And really bad eggs. Drink up, me hearties, yo ho!
What a great scene. And we're not here to discuss the soap opera between Johnny Depp and Amber Heard, even though that would be a great podcast as well, with a lot of good sound bites and YouTube clips, by the way. But obviously, given I've found this clip from Pirates of the Caribbean, Mikkel, I'd like to hand over to you, because it seems like the new strategies from the strategy from the Houthis in the Red Sea is one that resembles the Pirates of the Caribbean quite a bit. What's happening down there?
Yeah, or the Pirates of Somalia, to be more specific. Now, what we've seen over the past couple of days is, of course, a large attack on the Maersk Hangzhou container ship. This was a huge news story in Denmark, but globally as well. What we saw there was a combined missile strike, and then a couple of speedboats attacking a freight ship, basically. And because of all the American warships down there, they're not only attacking a freight ship, they're attacking an aircraft carrier as well. So the odds were definitely not in favor of the speedboats. They were wiped out of the sea. And but the attacks are continuing. We've seen a French ship attacked yesterday or on Thursday, I think. And the attacks in the Red Sea are ongoing. The Houthis are continuing to strike missiles and now expanding to these speedboat attacks. So, as a consequence of this, Maersk has announced a suspension of their travel through the Suez Canal, initially for 48 hours, now until further notice, basically. And we're seeing traffic through the Red Sea more or less stalling. This is has a number of effects. We'll get back to that. I'm beginning to see some reports of huge chains like IKEA and Home Depot beginning to feel the effects of late deliveries. And for the Egyptian government, I mean, and it was a ship targeted for Egypt today. This is huge. They're losing billions of dollars potentially from ships not going through the Suez Canal. So everyone in the region is affected by this. Potentially everyone in the world, and we'll try and dive a little into that.
Yeah, if we look at satellite photos from this week, it seems like container ships are all redirecting their travels south of Africa instead of using the Suez Canal, while we still have some activity in the bulk space, so basically oil tankers, LNG ships, etc., still traveling through the Suez. And Emil, I'd like to ask you about this. Do you think there's a reason why we see container ships mostly south of Africa, while oil ships, for example, still continue to a certain extent through the Suez?
I think it's largely driven by practical issues. First of all, if you bomb an oil tanker, it parties on. You can't send a rocket into a container ship and the crew can survive and everything else. But when we're talking tankers, it's a different issue. That's the first part. Secondly, obviously, the cost would simply be inflicted on many of the oil producing countries in the region, and they have no interest in going down that road. So I think that's the other part here. But obviously, as you know, as soon as you have shipping routes redirecting, you have increased cost base, you have increased also urgency from the demand side, right? People getting worried that they won't receive the shipments. So all of a sudden it becomes a bit of a self-propelling issue. So yeah, it's something to watch in the coming months for sure.
And if we look at the latest price developments, it's now very clear that freight rates on container shipments, that they're through the roof, basically. We're talking double up, sometimes even more than that, just compared to the prices ahead of New Year's. And Maersk, for example, they now try to broker deals with their clients on like 8 to 12 months horizons with these prices that are a lot higher than what we saw ahead of New Year's. So this is certainly something that will spill over to especially transportation costs initially in the inflation basket, and something that should be a worry to central banks. It will be very interesting to see what they say about this when they meet later this month. Mikkel, this story around the Houthis attacking ships in the Red Sea is obviously linked to what's ongoing in Gaza. And we've had some interesting developments in Israel over the course of the week, with Israel redirecting troops towards Lebanon instead of Gaza. What's ongoing there, and what's the link to the Houthis?
Yeah, so let me start. The Houthis are officially carrying out these attacks in solidarity with Hamas. It's their way of hitting Israel in the West. In reality, in my opinion, it's more of a domestic matter. They're shoring up support within Yemen. The Yemeni populace loves this. But enough about that. What we've seen in the last couple of days is that the Israelis have pulled some troops out of Gaza. They're still conducting offensive operations, but in my estimation, this is the first baby step towards a de-intensification of the operations in Gaza. They've pulled them apparently north towards Lebanon. This might be in expectation of a Hezbollah attack, because Israel carried out a missile strike on Hamas deputy leader within Lebanon, where Hezbollah is situated. So we are seeing some early signs of the Gaza conflict spilling over, of course, into the Red Sea. I think that's a bit of a niche case, but we're seeing attacks from Israel into Lebanon to hunt the Hamas leaders who are of course, not present in Gaza. They're sitting all around the Middle East in comfy places, but possibly also in Iran, because what we saw the day before yesterday was a huge terrorist strike on a memorial service in Kerman in Iran. It's still very unclear to everyone who did this. Obviously, the Iranians are blaming Israel. I can't really see any scenario where this would make sense for Israel to carry out a terrorist attack. It's not their style. What on earth would they gain from it? A lot of Iranian exile sources, who are of course anti-regime, are pointing to evidence towards this being a false flag attack carried out by the Iranian government. I'm not sure about that. What I'm sure of is that the Iranians have enough on their plate internally to really enter the Gaza-Israel conflict. They're doing this via their proxies in Hezbollah and the Houthis and Hamas, of course, but I really don't see a scenario where it makes sense for Iran to escalate things vis-a-vis Israel. So I'm not too concerned about these spillovers, except for the Red Sea, which has huge financial implications overall.
Yeah, it has. And as of now, what we know is that, for example, Maersk have decided on this redirection of ships until Jan 15, roughly. So, yeah, a time span of say a week to 10 days from here. We don't know what will happen after that. Mikkel, Emil, I'll allow you to give a few opinions here. Is this something that will have repercussions into February, March? Is it a prolonged stalemate, this, or what's going on here?
I don't think so. I mean, first of all, the first solution is a ceasefire between Hamas and Israel, and that's not completely out of the question in the coming weeks. It depends on how far the Israelis are willing to go and the pressure on Israel from the US. The other solution is to make the Houthis stop, and there are two ways to do that. The obvious one would be increased American attacks, perhaps into Yemen, or perhaps have the U.S. Navy attack some of the Iranian ships that are directing the Houthi attacks within the Red Sea. I think that's a step the Americans are holding off on. They are possibly hoping for the Houthis to simply grow tired of this. I mean, if they have to carry out these attacks via speedboat, it's basically suicide missions, and at some point you get tired of suicide. I mean, there's a limit to how long the Houthis are going to keep this up. They have demonstrated their willingness to attack Israel. They're not really gaining anything from this except internal support, and at the end of the day, it is in no one's interest to attack freight ships. So I don't see this as a long-term problem. The ships are not being sunk. I mean, the U.S. Navy is there. So, I mean, at some point over the next weeks, months, I expect to see travel, or to see shipping routes redirected through the Suez Canal again. But that could still have huge implications if this lasts for say a month.
Emil, anything you want to add on that? Yeah.
Yeah, I think the like what I'm really watching here is all the messaging coming out of Tehran. I think essentially they are the ones who could really put an end to it from above, so to speak. I think the Houthis won't indulge in such endeavors unless they had the blessings from Tehran. And the question mark here is, to me, whether the Iranians really have the appetite for escalation at this point. So I think that's the big risk here. And I think that's what the Americans are attempting to by sending in ships into the region. I think in a more if you assess it from a risk perspective, and that's really I would like to ask you, Mikkel, actually, because I'm it's really unclear to me, like, to what extent can they even control the Houthis at this point? I mean, if they're armed to the gills and they're willing to create chaos, it's
Yeah. You mean the Iranians? I mean, it's questionable how much direct control they assert over the Houthis. One way is, of course, to stop the flow of missiles. Another thing would be to remove the Iranian ships from the Red Sea. That could be some back-channel deal that the Americans and the Iranians are working on. If the Iranian ships don't call the shots stop calling the shots for the Houthis, it becomes a lot harder for them to hit the ships. If they don't supply missiles, then the Houthis will have to turn to these Somali-style gunboat attacks, which they will quickly run tired of. I mean, they're not gaining anything. It's basically suicide missions. So the Iranians have a huge hand to play in this. I think it's very much a matter for these groups to do something. They cannot be left embarrassed by inactivity while Hamas is fighting Israel. So I think in Iran, in Tehran, they're really hoping for a ceasefire soon to have a way out of this. Then Iran will have done. They can point to having done whatever they can, but I don't think Iran is looking for a larger escalation than this.
But I mean, ultimately here, it's also interesting that from a market's perspective, Maersk is gaining like crazy in equity space, and similar companies the same, right? I think Maersk is up more than 15% by the time of talking here, just since New Year's. It's a crazy move, and so far they can pass through costs to clients. They can even increase margins, it seems, as a consequence of this. So they're not the direct losers of this. It might be that consumers are by the end of the day. But since it's one of the first podcasts of the year, let's talk about something positive instead of all of this malaise in the Red Sea. And as you can see here, we've basically turned the studio into a gay pride parade with all of the stuff that we've put on the walls and on the microphones, etc. For those of you watching, we have New Year's celebrations all over the studio. And we were actually planning on a tremendous January because of a great liquidity addition from the US Treasury paired with a liquidity addition from the Federal Reserve, those two in conjunction. What we basically envisaged ahead of the year here was an liquidity addition based on a further withdrawal of liquidity from the overnight reverse repo facility, money being pulled out of the Federal Reserve into private repo markets or into T-bill markets, creating private deposits along the way. And liquidity has actually improved quite a bit, but still equities are shaky here because of what's ongoing in the Red Sea. So, Emil, assuming that we can set this Red Sea debacle a bit aside, do you still find reasons to be an optimist here? Or what's your take on this cocktail of increasing liquidity and geopolitical tensions?
Well, far be it from me to exercise a bit of schadenfreude, but if you remember back in December, I did say that that Powell's pressure would perhaps come back to bite him. And alas, here we are with ship freight rates pumping up and liquidity really creating some tailwind. So I think they might, they have an issue at the Federal Reserve right now, I think, at least momentarily. The overall pricing pressure going forward should still be within control and range, but nonetheless, I think when you have such a vast move in such a short space of time, you're playing with fire. That's my view on. So the other losers, but consumers are central banks here. But leaving that aside, I think usually liquidity tend to support asset prices, and it will probably keep at least a floor on it coming forward. But what I'm really sort of worried about is the overall sentiment and long position within risk assets, and I still think that's a major risk that could potentially revert. So I'm not too keen on getting long here, to be honest with you. So that's how I look at this conjuncture right now.
Yeah, and we've certainly seen a mini washout of positioning so far this year, both in fixed income space and in duration-like assets in equity space. Our asset allocation model actually points to defensive equity allocations, but still a net long exposure for the month of January when we enter our assumptions on liquidity growth and inflation, basically meaning that you should buy utilities, consumer staples, stuff like that. And so far, so good. Yeah. We're long that stuff heading into the year, and it's been a great call instead of being long technology. And speaking of technology and high-risk assets, Mads, I'd like to bring you into the discussion as well, because
you bet.
I looked at the Bitcoin chart, I think, swiftly into the new year on 1st of Jan, and it looked like a big New Year's celebration, basically, in Bitcoin. And all of a sudden, it reversed. What happened there? And do we have any evidence of who bought the 1st of Jan and what happened there?
I think in general, we know that the US SEC, they will most likely approve this Bitcoin spot ETF by January 10th at the latest. So I think it was just suddenly we went into the month where the market and all us analysts, we really expect the SEC to put the to put the ETF out there. And then suddenly on Wednesday there was coming a research note from like a really unknown broker, crypto broker, which said that they did not expect the SEC to approve the ETF, and suddenly it was picked up by all the big crypto medias around the world, and within a matter of pretty much minutes, Bitcoin tumbled by 10%. There were some over 500 million worth of long positions liquidated, and it also tells you the state that the crypto market is in right now. It is so much on its toes, and just small news can just like completely break the narratives around the ETF.
So when we look at the spot ETF, both for Bitcoin but also for Ether, what's your base case here? I mean, is there anything to this story published earlier this week? It's obviously tricky to know what's ongoing behind closed doors, but is it still the base case that we get a spot ETF both in Bitcoin and Ether space within a couple of weeks?
At least for Bitcoin, it is our base case that we get it. We see all this. Also, just this week, we see all these issuers. They are making modifications to their ETF filings. And what we hear is that these modifications, they are at the request of the SEC. So we are pretty sure that at least the Bitcoin ETF that comes next week, and then probably an Ethereum ETF will follow within 6 months or so.
Okay. And obviously very interesting for price action. Maybe this is a classic buy the rumors, sell the news kind of event.
Yes.
And in such case, I guess it makes sense to bet on Ether rather than Bitcoin.
Yeah, for sure. I would really like ETH actually now, because although that BlackRock filed for the Ethereum spot ETF back in November, it did not get the love that really Bitcoin got. So it seems like the market completely overlooked the same narrative just for Ethereum instead of Bitcoin.
And speaking of liquidity and the impact on risk assets such as crypto and technology, it's time to play the soundbite from Donald Trump of the week. We always have a soundbite with Mr. Donald Trump. And when we talk about liquidity, we obviously also need to talk about issuance of US treasuries, because those two themes are so interlinked. And this is a soundbite from a CNN program where Donald Trump is asked about the debt ceiling. So it's quite a while ago, but the debt ceiling will become interesting towards the presidential election later this year again. So here's Donald's take on the debt ceiling and how to deal with it.
As you know, the U.S. right now could be just 3 weeks away from defaulting on its debt. That could mean millions of jobs lost, people not getting their Social Security payments. People believe it would put the U.S. economy into a recession. On that topic, I want to bring in Marta Cervella, a student here at St. Anselm. She is an undeclared voter who did not vote in 2020. Marta, what's your question?
Hi, Mr. President.
Hi, thank you.
So my question is, what do you think about the United States' current debt situation, and how can we move forward?
Such an important question. So we're at $33 trillion, a number that nobody ever thought possible. When we had our economy rocking and rolling just prior to COVID coming in, like literally, we were making a fortune. And oil, we were going to make so much money from oil, we were going to start paying off debt. But then with COVID coming in, we had to do other things. We had to keep this country alive because it was so serious. But we have to get the country back. We have to lower energy prices. We have to lower interest rates. Interest rates are through the roof. Energy has to come down. It all has to come down, and we have to start paying off debt. But when we have a debt limit, and they use that very seriously to me. They came in, Schumer came in with Nancy Pelosi, and they were using it. We'll violate it. We'll do whatever. They talked a whole lot different than they do right now. I say to the Republicans out there, congressmen, senators, if they don't give you massive cuts, you're going to have to do a default. And I don't believe they're going to do a default, because I think the Democrats will absolutely cave, because you don't want to have that happen. But it's better than what we're doing right now, because we're spending money like drunken sailors.
So just to be clear, Mr. President, you think...
And let's move back to the studio from the clip with Donald here. quite interesting to have at the time a president saying that, well, it's certainly an option to default. This could, of course, be part of a negotiation tactic, Mikkel, but I mean, ahead of this presidential election, we know that the new Republican leadership, basically in Congress, is relatively right-leaning compared to what it was. And there are, I mean, sources within the Republican Party supporting such a stance.
Absolutely.
So what do you make of this whole discussion on the fiscal deficit and the issuance pace and all of that ahead of the presidential election?
So I think the Republican Party has become even more hawkish within Congress. They're basically all on the Trump wagon on this. But the thing that's changed a bit since this interview is that the Republican Party seems likely that they can be bought by other policy areas. When we talked about this back in October, I think it was, I predicted that the US that Biden and the Republicans would come together the European way, that they would exchange voting for the budget with immigration laws, basically tightening immigration laws. I was completely wrong about that. It all became an issue of ending the wars, of stopping Ukraine funding. The last couple of days and weeks, it seems that the Biden administration has been able to shift focus a little bit. The new Republican leadership is not as focused on Ukraine, so I think the issue is very much back to immigration. And that's an area where Biden can give a lot and can cave a lot. The Republicans will be asking for a lot of cuts, but I think they will have they will be able to do some deal with combined with some massive new border walls or whatever Donald Trump would like as well, probably, and some immigration cuts. So I think there is an avenue there, but it's still going to be short-term deals. I don't think any long-term deals are going to be cut this side of the presidential election.
Emil, it's pretty typical to see extraordinary spending in a year of elections. And should we see extraordinary spending on top of the extraordinary spending we saw last year, it kind of ramps up, doesn't it? I mean, what do you expect ahead of this election? Should we actually expect issuance to increase here?
Yes, I think there's a high risk of it, but from the variety of drivers. First of all, if we see some material economic cooling and lower revenues than anticipated, Yellen will have to respond to it, obviously. But if we leave that aside, I still think that from a political standpoint, I think you would want to come into the election and perhaps even the next year with a decent cash buffer, so you have some leverage in making a deal. The Republicans coming into the deadline. So that's another thing. But as far as making or as far as wiggle room to actually enhance the already planned spending plans, I think it's a tough ask. You need some creative guys in the administration, and perhaps Biden has them in abundance. But I'm unfamiliar with their plans, unfortunately.
And the ultimate question, when we basically deduct all of this, is that is inflation going to wane if issuance remains high, and if the Houthis will continue to wreak havoc with supply chains in the Red Sea? And once again, last week, we were at least partially right that European inflation would surprise markedly on the soft side of expectations. Expectations slowly but surely converge towards our view, but inflation is waning pretty fast in Europe, live at least. The question is whether we will see lagged spillovers of the supply chain disruptions in the Red Sea. I wouldn't rule that out, but in case we do not see large disruptions and large price increases to transportation, I'm of the view that the European Central Bank is off by maybe 1.5 percentage points in their inflation forecast for just the first quarter of 24. It's very interesting to see how central banks expect January to deliver relatively large price spikes across the board in seasonally adjusted terms, basically saying that the January discount season will not be heavy. I strongly oppose to that view. What we see right now in terms of credit card spending, what we see right now also when we scrape price points on the internet, is a very strong discount season, basically because consumers are under pressure. So everything points to seasonality returning to normal, meaning that we see substantial price cuts in January. And that is not the base case from at least the European Central Bank and the Bank of England, for example. So I guess there's still a short-term scope for inflation to surprise on the low side of expectations. The good thing here for us as forecasters is if freight rates continue to increase over the next couple of weeks, we will actually be able to forecast consumer prices a couple of months in advance, because when a ship leaves, say Colombo in Sri Lanka or Shanghai, or wherever it is, with a destination in Europe, it takes a while before that pass through from freight rates to retailers to consumers is ultimately ended. So what's happening right now will likely impact March numbers. That's what I'm saying. It will not impact January numbers outside of the direct shipping costs, and that's still a minor portion of the consumer basket. So very interesting juncture here, because Emil, and I'd like your take on this as well. Should inflation re-increase this year, it will likely wrong foot right about everyone, including Lagarde, Powell, Andrew Bailey, you name it, right? I mean, it's basically the worst case scenario for everyone.
Yeah. Oh, absolutely. And it's also a big question mark if I mean, even if it doesn't, and I mean, have you heard the latest can rattling from the FOMC members, suggesting that rates are likely to stay at the elevated levels for longer than what the market is currently pricing in. That alone should wrong foot plenty. So if you actually have some real economic divergence on the side, back in that story, I think we see bloodbath. It's not my main case, to be honest with you, but it's nonetheless something to hold on to.
Yeah. We've actually made a small study on the European inflation index and the sensitivity to freight rates. And, well, it goes without saying that transportation costs are very sensitive to freight rates. Well, no shit, Sherlock, right? Clothing and footwear is very sensitive to it as well. So basically, all clothing and footwear arrives from Asia by now, meaning that freight rates will obviously impact pricing. And we also see a clear impact on the costs of housing, water, electricity, gas, and other fuels, again, because of transportation of these things. So the direct impact will be seen in these categories, while the rest of the basket is not at least directly impacted a lot. Also because a lot of shipments arrive via the air routes for some of the other categories. Point in case here, this is a story to watch. For now, we still see downside surprises to inflation, especially in the Eurozone and in the UK, also partially in Scandinavia, while it's debatable in the US. The evidence is much more mixed. So final debate of the show for this week. If inflation returns, what should we do about it? Is there a smart way to allocate for this ahead of it? And I'd like to start with asking you a question, Mads, and I think this is $1 trillion question in crypto space.
It is.
Is inflation linked to crypto, and is crypto a good inflation hedge?
I will say something which I think that the market and the industry will hate me for, and that is that crypto is for sure not an inflation hedge. Crypto in general really likes liquidity, is probably the most sensitive asset class to liquidity. And whenever inflation returns, at some point probably it will, then we will see the central banks decreasing the liquidity, which will hurt crypto for sure. But of course, it also depends on what time frame you have. If you just have a long enough time frame, then crypto will probably be a hedge, but not in the short term.
Yeah, I would tend to agree with that assessment. Emil, anything that seems particularly attractive from a risk-reward perspective, given this Red Sea turmoil, should we just buy shipping companies here as a hedge, or what do we do about it?
Nearly. I think if the inflation story really starts to gather attention again, it very much depends on the drivers of it. Given the odd drivers of the U.S. economy at this point, where it seems as if at least consumers and to a certain extent also businesses are at least keeping somewhat afloat, and public spending still hamping up. It's hard to see demand surprising much to the upside, which means that if we really see another inflationary, perhaps not wave, but re-emergence, let's say, it will probably be due to supply issues, right? And that's basically what this story tracks. I think something to watch here is the spillover into other freight rates, especially if it starts hitting the tanker space. It would also impact both core prices and thus, keep the seats hot at relevant central banks. But generally speaking, I think as long as it's supply, you probably want to be long the spot commodities and various proxies. Whilst if it's really another cyclical wave, let's say, where activity keeps up, that's the other ballpark, right? It's manufacturing and all that stuff, utilities perhaps even. So that's how I look at it. But it's a risk rather than my base case, let's say, right now.
Yeah, and fingers crossed for a much more calm situation in a couple of weeks from now in the Red Sea. I don't think we need another inflation wave, to say the least, and I think I speak on behalf of all consumers when I say that. We will obviously stay on our toes here, talk to our network within the Danish shipping industry, because Denmark is, for once, center of attention, at least to a certain extent, in this story, with Maersk being the target of a couple of attacks. As I said earlier, what we hear right now is that they try to increase prices materially on container shipments, also with a time frame of 8 to 12 months if clients actually accept it. They can obviously also see this situation, and if they strike a deal now, then it may be cheaper than it is in a couple of weeks if the Houthis continue. Mikkel, Rosenvold, great to see you again. We will likely also invite you back in the studio given this situation in the Red Sea. Also great to see you, Mads.
Thank you.
Once we have news on the spot ETFs, we will certainly bring up the discussion on whether it indeed was a buy the rumor, sell the fact kind of event in crypto space. And Emil, hope to see you again on a running basis. As far as I'm concerned, there's at least 9 months until your wife gives birth again. So.
Yeah. And if you want me out before that, you probably need an argument with my wife, I fear.
Okay, fair enough. So the final thing we've got left in the show this week is to remind you of our disclaimer, because we have the best disclaimer in the world, and given the uncertainty in the Red Sea, I guess it's a good idea to play the disclaimer actually this week. So remember, when we discuss trade ideas in this show, there are sometimes may be good, sometimes may be shit. Thank you to Gennaro Gattuso, and to those of you watching and listening to the show. We'll be back again next Sunday with more. Remember that this is just an appetizer to all of the content that we deliver at stenoresearch.com. We have a tremendous offer for you from the get-go of the year. Macro